We appreciate you taking the time to be here this evening with us. Just a couple of quick housekeeping rules. If you'd please mute yourself during the presentation, we'd appreciate it. If you have questions, you can, and Rachel can answer questions on your behalf. So you can unmute at that particular time and ask the questions. You can choose to have your video off or on. If you'd like to see everybody, you'd like people to see you, or if you didn't do your hair today, then that's okay. You can turn your video off. But as our friendly undertaker tells us, it's always better to be seen than to be viewed. So just keep that in mind. And then the other thing is this presentation will be recorded, will be available to you on Monday, and LCG is going to be sharing a slide deck with us that we'll also be able to share with you on Monday. We can send it to you by email. So if you're interested in that, then reach out to us and say, hey, please send that to me. We would like to have the recording and the slide deck, or either or. So let's get started. The Catholic Foundation and LCG have had a relationship since 1994. LCG is the investment advisor for the foundation. We pay them a flat advisory fee. They vet the underlying managers, but they do not earn anything from putting certain managers in front of us. I mean, this is their job, is just to take a look at the managers and take care of us. The Board of Trustees and our investment committee is responsible for creating an investment policy statement, which provides a roadmap for asset allocations, risk tolerance, and so forth. And LCG is there to help ensure we follow those guidelines and live within those guidelines. The investment committee of the foundation consists of 6 trustees. It's by far the largest committee on the board. And of course, they're managing a little over $292 million right now. So it's they got a big job in front of them. So I'm pleased to introduce Brian Falco, who's Senior Vice President and Principal at LCG Associates here in Dallas, and Rachel Foss, who's CFA Consultant, LCG Associates in Atlanta. And Brian and Rachel, thank you for sharing your time with us and expertise this evening. Brian and Rachel are both our key people, our interface with LCG here in Dallas. So we get to see them quarterly. So I'm gonna let you guys take it from here, Brian.
Okay, thanks for having us. We're glad to be here. I'm going to, I hope, share my screen. Can you all see that?
Yes, they're all muted, but I can see it.
They all follow directions, which is a good thing.
There you go.
Okay. Thanks for having us. Glad to. Can I move this thing in your way? I don't want that. Glad to be here, and I'm going to walk through the slide deck. It's not too extensive. It goes through a quick overview of LCG, and then some of the ways that the foundation is set up, and then into the investments and how we look at it. So the first part will be really short. That is the LCG part. I'm not going to do a big commercial. Like Matt said, we've been working with the foundation since '94. The firm's been around since '73. I guess the 2 or 3 real quick things you need to know is we're independent. We own ourselves. As Matt said, we only make money directly from our clients. Our clients today are about 100 and about 113 billion in assets. The firm is set up so that all of us do research. We're not just client facing. So Rachel and I also do all the research that are behind all the work that we do. And we help the foundation in a lot of ways. Kind of the main ways are implementing investment policy, picking managers, setting up portfolios, reviewing those over time are probably the most standard, but we'll do anything that Matt and his group needs as far as investments go. This slide you've probably all seen a million times. It's been around forever, but it just goes to the point of the most important decision you'll make in the entire process of setting up an investment portfolio. As a church or a donor or whatever is deciding on the asset allocation, it's going to be the predominant driver of returns, more so than what managers you pick and things like that. So, the study's been around forever, but over 90% of the determinant of your return is the asset allocation that you put in place. And I'm going to actually skip a slide because I think it slides into this one really, really well. The reason why it's important is Obviously, the returns of equities are going to be significantly different than cash over time, and all the things in between those two. But the driver of where you decide to put your money should really be the time horizon that you have in place, where you would need to spend money. And you can see these are the 5 pools that the Catholic Foundation currently has. They range from very conservative at the money market end all the way out to the growth. And you can see how the allocations are in place today. And we go from about 70% equities at the far end of the risky side down to 0 at the most conservative end. And the important line on this would be the investor time horizon, which is the gray line in the middle of the slide. And it's just a good guideline that we try to put in place so that when you're making a decision on which bucket you would want to invest your money in, you can determine what your time frame is for when the money will be spent, and be able to set up the risk parameters appropriately with that in mind. We added this slide a couple years ago when we did this presentation, and it was really to show what an unusual time period we were in. If you look at the last 2 years, 2 calendar years that we had, 2022 was a really strange year. I think we all remember it. It's down here in the far bottom left part of the chart. And it was a year where stocks were down almost 20% and bonds were down over 15%. Not a situation we've seen very many times in history. You can see there's only actually been 3 from this time period we looked at where we've had a negative return in both stocks and bonds. We then flipped that forward to 2023, and we saw the portfolio go into the quadrant you want to be in, or not the portfolio, but the investment world. And 2023, you can see, was positive for stocks and bonds. And then this year, which I'll touch on a little bit of the returns that we've seen in the first quarter for the portfolios, but to kind of put it into perspective, we're at this, I think it's orange dot, and that's that we have a positive return in stocks, which I think everybody is aware of, and we have a negative return in bonds as rates have started to rise from the beginning of the year through now. Before we get into the returns and kind of what's happened in the market, a couple of, I guess, reminders of why we set up things the way we do, and why you stay invested over time. I know everybody's probably seen this one too. And you could argue you can make the flip for the a flip chart for the other side of it. But if you're out of the market for a good amount of the best days, your returns change very rapidly. So if you missed in this time period from 72 to 2024, the top 40 days or even the top 20 days, your returns went from 10.8 down to 7.9 or 6.1%. So this is why we try not to time the markets. We try to have a strategic allocation and over time rebalance back to those allocations so that you do capture the days that were the best. Obviously, if you miss the worst days, you probably would see the flip of this, but it keeps the emotions out of it, and it makes the decisions a lot easier. So kind of on to what's happened this year, and I kind of mentioned a little bit, stock market's up. A lot of that is a continued good earnings and things from companies. The inflation has come down a bit. Unemployment's still pretty low. So from that standpoint, the markets have responded pretty positively. But the biggest thing we've seen this year is coming into the year, the market anticipated that rates were going to be cut by the Fed several times. In fact, the anticipation coming into the year was like 6 or 7 times. You can see what's happened since the beginning of the year. So this is just looking at the May meeting, the May Fed meeting, that on January 12th, when it was at the peak, the market felt there was 100% probability that we would see a cut in May. And you work forward through time, and the market has started to decide that the Fed's actually telling us the truth, and they're going to stay with higher rates for longer. And you go all the way out to the end of March, and you can see that the market now says there's a 90% probability that there's going to be no change in rates in the May meeting. So all this movement kind of led us into a period of time where we came into the year with lower rates. And because the market has finally decided that the Fed's going to keep rates higher for longer, rates have slowly creeped back up. And when we get to the fixed income slides, you'll see that has created negative returns in the bond market. But let's start on the equity side. And this is a look at not just the first quarter of 2024, which is the darker blue lines on the top chart, but also the last year. And I think most people are probably aware of what we saw last year and kind of into this year, and that is the returns of the, whatever they call it now, the Magnificent Seven stocks that were driving the market. And that's the NVIDIAs and the Amazons of the world, and a lot of these large tech stocks. You can see on the top of this chart that the two places where we saw the best returns in the last year were information technology, where a lot of those sit, and also communication services, so all the way over here on the left. And so those two segments of the market returned well over 40%, in fact, almost 50%, and other parts of the market did not keep up. So we saw a massive dislocation between growth and value stocks. And if you look down at the bottom right-hand table for the last year, you'll see that on the large cap side is where it's most extreme, because of those 7 stocks. That large cap growth stocks were up 39%, and value were only up 20%. I'll talk about how this affected the portfolios when we get to that page. But you can also see that it kind of continued into the first quarter, but not as extreme as it was, with large cap growth being up 11% and value being up 9%. If we then look at the markets outside of the US, we can see a similar pattern, but not quite as extreme. The reason for that is those dominant players on the technology side that have driven the market aren't outside the US, they're inside the US. You can still see that technology did really well outside the US for the last year, up 31%, but not near what it did inside the US. And the difference between growth and value was much more muted because of that. You can see growth was up 17% in the developed markets, value was up 13%. And then if you went to more risky parts of the world with the emerging markets, you saw returns were a bit lower than they were in developed markets, with the average emerging market up 8.2% and the average developed market up 15%. So lastly, on kind of the asset class experience for the last year, we'll look at fixed income or bonds, and you can see the top part of the chart is the yield curve, and you can kind of see where we came from. We ended the year in that light blue line that's in the middle, and as I said, as we went through the quarter, the market started to anticipate higher rates for a long period of time, and the yield curve shifted up to the dark blue line. Because of that, right, if yields go up, prices go down. That's how bonds work. You can see at the bottom part of the chart what happened in the first quarter. The Barclays Ag, which is a measure of basically the entire investment grade bond market in the US, was down about 80 basis points. It's actually down 2 or 2.5% or something like that now. So rates have continued to go up. But through the first quarter, you can see how that affected it. And the more duration you had in your portfolio, so the longer dated your bonds were, the more negative you would go, which is typical. So you can see long bonds in the US were down about 3% in the first quarter. To get any returns whatsoever in the bond market during the first quarter, you had to either be in emerging market debt or in bank loans, which is floating rate securities, or high yield, which had enough yield to offset the duration moves. Last slide on the fixed income and kind of on the market is a look at spreads in the fixed income area. And we bring this up to show you kind of the risk that the bond market is perceiving today. You can see we're at very, very tight yields. So this would be the amount of yield that the Bloomberg aggregate, I'll use the top chart, that their corporate bonds are yielding over treasuries. So what are you getting paid to take, I guess, in essence, more risk? And you can see that over time, the average is about 150 basis points that you get paid for holding corporate bonds over treasuries. And today it's at about 90. And the same can be said for high yield, which is even riskier area of the market. the average is a little over 5%, and today it's right about 3%. So yields are really tight. Rates have stayed high or moved a little bit higher as we went through the year. And that'll lead us into kind of the portfolio. This was another page we had in here from a previous presentation that was in a little bit more of a challenging market than we're in today, but I think it's always a good reminder. Why do we keep a strategic allocation and rebalance over time? And what do you do in a challenging market? Our advice is, you remain patient, you keep your strategic allocation, you evaluate your cash needs, especially now that you can make money in money markets, a little over 5%. Putting 6 or 12 months of cash needs aside and earning that 5% is certainly a good thing to do in difficult markets, and then making sure you rebalance over time. So onto the portfolio, and this is the underlying managers for all the 5 pools. They're just in different weights depending on what pool you're in. The domestic equity portion of each of those portfolios is invested in an S&P 500 index fund that's screened for Catholic values. And you can see over time the difference between the returns you got in this investment and the S&P 500 would be a combination of stocks that were left out because of Catholic values. It could be a positive at times, it could be a negative at times, and fees. And you can see over the last 5 years, it's actually been a net positive. The portfolio has returned 20 basis points more than the S&P 500 after fees. So it's been good. The reason this has been a really good investment over the last year or even the first quarter has been the domination of those growth stocks that I talked about, those 7 stocks. They're the largest part of this index. And you can see if you didn't index, it was very difficult to beat the S&P over the last year or even the first quarter. The average manager out there returned 9.8 for the first quarter, and you can see the index returned 10.6. And for the last year, it's about 350 basis points has been the difference. So it's been really, really difficult to beat. And having that as the sole investment on the domestic side has been a very big positive. Especially because large caps have also outperformed mid and small caps by a decent amount during this time period. So down to the international managers, we have 2. We use a value and a growth manager in this area, and we're active. And we're active because the markets are not as efficient, and over time you'd hope to beat the benchmark. You can see for the first quarter, fairly difficult for both managers, and even for the last year, they trailed by a little bit. A good amount of the difference here has been, we'll use Harding Loevner as an example. It's really the only manager on the page that's had a fairly difficult time for this time period. They hold about 25% of the portfolio in emerging markets. I talked about earlier how that's not been as good of a place to be over time. It's an active decision that they make. And so they've trailed the benchmarks during this time period. But we think having the balance between the growth and the value managers is a positive, and over long periods of time, they should do pretty well. If you later in the presentation, I probably won't go over it, but if you get the presentation, you'll see we have a page on each manager, and you can see that a manager like Harding Loevner over rolling 5-year periods does a very, very good job. They just happen to be in one of the rare time periods where they underperform by a little bit. So moving down to fixed income, we kind of have a similar strategy in that we have 2 managers in place. One is Baird and one is Dodge & Cox Income. Baird is a very high quality, well, they're both very high quality managers, which means they're not going to have a lot of high yield in the portfolio or things like that. Currently, you can kind of see first quarter, they both outperformed by a little bit. 1 year, they both outperformed by a decent amount. Most of the reason for that is twofold. One, both portfolios have a slightly lower duration during that time period than the benchmark has, and duration's has not been your friend necessarily during this time in the market. And 2, both have a portfolio that yield 50 to 90 basis points higher than what the market yields. So that's actually rolled down to the bottom line, and they've actually been able to outperform during the past year. And then the last thing we have in the portfolios is the money market. And you can see we're finally making money on money markets. The last year has been 5.3%. We're probably right around that still, maybe a little bit higher today than we were for the last year. But for years, that was a zero. And so it's kind of nice to be in a market where we're making some money on the money market. Last thing that I had to cover, and then we can open it up for questions, is just there's a page like this in the presentation for each manager. But the important things to take out of it are, one, that top line is the actual performance that the Catholic Foundation has experienced during the time frame. It's bolded. It shows also the standard deviation that you've had during that period of time, which measures relative risk. There's some information on each of the managers, for instance, how many securities they hold, what's their market cap, the PE, and then dividend yields. You can see here probably a good example what or how many stocks get screened out because of Catholic values. You can see it's about 60. So you hold 441. Most of those stocks are higher PE stocks, a lot of healthcare and things like that. So the PE on the portfolio that y'all are invested in is priced better today than the rest of it, and has about the same dividend yield. We also include calendar years. We include some information on the specific strategy in the firm. So in this situation, the firm, you can see, manages about $9.5 billion. The strategy is about 3.5. It's a mutual fund vehicle, and the fee that you pay is 9 basis points. And if you go to the bottom right, you can kind of see what I was talking about with the stocks that were out of the benchmark and where you'd see that. And you can see it's industrials and healthcare, which was underweight versus the benchmark, and that's where the stocks would be pulled out because of the Catholic values. And then the left-hand side, we like to look at returns on a rolling basis, because a lot of times on a specific endpoint, they don't show you what makes the most sense. And you can see being invested in the index over time has been a very, very good strategy. Basically, if the blue line is on the top half of the page or the chart, you're outperforming over half of the managers in the universe that are active. And if you're in the bottom half, you're underperforming. So you can see it averages beating about 71% of managers over time, and is in the top half 91% of the time. So that's, if you look at each of the managers, you'll be able to see it, but that's how you read this chart. I think it's an easy way to get a quick glance and see what's happening. I know
Brian, thank you for that very thorough review, very quick review.
It was quick.
I'm sure it's like drinking from a fire hose, but let's open it up for questions. Any of you have any questions that you'd like to ask Brian or Rachel?
I was that thorough.
So we do have a question in the chat for who are the Magnificent Seven.
I'm trying to think if I can come up with all 7 on the top of my head. And Rachel, maybe you can help me out. But the biggest was NVIDIA, as far as return goes. Amazon, Apple, Netflix. What am I missing, Rachel? I'm missing 3.
Tesla, although they've come down now.
Yeah. So I'm only missing 2.
Meta,
Google,
right. Yep.
Google, Alphabet.
Google.
There you go. Thank you. Yeah, if you look at 2023 as a year, those 7 stocks were responsible for, I don't remember the exact number, but it was like between 60 and 70% of the return of the S&P 500.
Okay, you got to have some questions from St. Anne's. I got to hear a question. Somebody's got to come with one.
Well, this is Jean Rickert from St. Mark's, so I hope that will suffice.
Yes.
Matt, at the top of the hour, you said that Catholic Foundation pays a flat advisory fee.
Correct.
And how is that then divided up among the the schools or the parishes investing? Is
Well,
it by just divided out evenly monetarily or by entity?
It's based upon our total assets that we have. So it'd be averaged out according to that. And the results that you see on here on these slides are already, that's net of fees.
Everything, yes.
Okay,
The fees are already taken out of that from that particular case. So if there's a, we don't have a slide, I can get a slide for you that shows, because Brian was talking about the different costs and each of the pools has a different variable, and some of them are maybe like the money market's gonna be very low, but you might get up to, I think in the growth, it's something like 30 basis points
Yeah, it's in that range. Yeah.
on average, something like that. So, but those are the results that we're presenting to you are net of fees, net of the investment fees themselves.
okay, thank you.
Yeah, and you mentioned Matt's mentioning our fee, that we're flat fee and all that. The flat fee is for all the pools that we work with at the Catholic Foundation, and this is just one of the areas that we work with them on.
Yeah, not all of our monies are in these pools. So these pools are set aside for organizations and for donors. And as you get higher up in money, over $1 million, organizations or donors can have their own pool. The monies that we have, for instance, our unrestricted fund from which we give our spring and fall grants from, has a totally different investment strategy. In that case, we're using a lot of alternative investments and so forth because we are really focused on the 10-year horizon. So any other questions from anybody on here? Love to have, Brian and Rachel are here, so you got the experts here. This is the time to ask.
I have a question around just portfolio construction. I mean, your international fraction as a portion of the total equity looks to be around 40% in most of the funds, maybe a little over, maybe a little under. Where is that decision made on the international versus domestic split on the equity side?
Yeah, good question. That's a decision we make with the committee. I would say it's come down over time, and if you look at the breakout of a global index, we're probably a slightly higher than that right now. So when we meet, each year and look at the allocations, we don't change them that often because you can't be that reactive. But every, I'd say 3 or 5 years or so, we'll make adjustments. So we're probably a little bit at the high end today on the international side than we would typically be.
Yeah, not Monday morning quarterbacking at all.
Yeah.
I mean, I think we all wish we didn't have any international. But
Agreed.
that's
Agreed.
Some things are going to go up and some go down if your portfolio is diversified. So
Exactly.
All right, I appreciate everybody being here today. If you have questions, I mean, we can reach back to Brian and Rachel at any time. So if you have something specific that you would like to have reviewed or discussed, we'll be happy to reach back with questions there. Just a reminder, if you are interested in getting a copy of this recording or the slide deck, just let us know and we can make that available to you by next Monday. But other than that, if no more questions, then I would wish you all a good night and thank you for participating tonight.
Thanks, everyone.
Thank you.